This is Horizons Middle East and Africa, our top stories this morning. The bond blowout goes global. Japanese benchmark yields soar to their highest in more than a decade after Germany's spending plans send 10-year bonds tumbling, the most since 1990. The U.S. slams the brakes on tariffs, agreeing a one-month exemption for the autos industry. Now the agricultural secretary tells Bloomberg a carve-out for some farm products is also being considered. Plus, President Trump warns Hamas there will be, quote, hell to pay if it doesn't immediately release hostages from Gaza. We'll bring you all the latest from the Middle East. Good morning to you, or good afternoon wherever you are. It's just gone past 8 a.m. across the Emirates, 6 a.m. here in South Africa. I'm Jennifer Zabasaja in Johannesburg. And boy, what a blowout was it for global bonds on Wednesday. We will see how the markets are shaping up right now, just heading into the trading day on Thursday, at least globally. When we just take a look at U.S. equities, though, pulling back right now ever so slightly after quite a turbulent session that we saw on Wednesday. Much of that was due to a lot of the tariff uncertainty. We saw an early pullback in many of the U.S. indices, though we did see them closing higher after a number of traders did digest this information from the administration about the exemption. We saw the S&P index actually snapping a two-day losing streak, but as you can see, marginally down right now. As we mentioned at the top of the show, the global bond sell-off really was playing out largely due to this uncertainty. But if you just take a look at German bonds, that's where a lot of the action was. We saw German bonds ending Wednesday with the worst day since 1990. The sell-off is continuing right now with German bond futures currently down right now just about 0.7%. Though what potentially a positive, though, for emerging markets on Wednesday was expectations of a slower economy. We're seeing the fiscal shift in Europe and also rising tariff pressure potentially helping to lift emerging market assets right now. The MXCF index for equities right now up just over 1% there. And we're also seeing bonds and currencies in developed markets rising as well. And finally, we have Brent crude on the screen right now, edging higher, but after 3 straight days of down days right now, Brent crude at just about $69.66 a barrel. And actually, we're seeing Morgan Stanley, one of the many bears out there, lowering their Brent crude price targets for the rest of the year. And let's just bring you this terminal chart. It digs into more of the FX story that's playing out, especially with the euro. We're seeing the euro's recent rally, seeing the currency up and up over its 200-day moving average. That's compared to the U.S. dollar. We're seeing the currency's best 3-day rally since 2015, and many investors are expecting the rise to continue to bet about 10% of growth potentially in the coming few months for the euro, and especially as we continue to see fiscal shifts in the bloc. Let's check in, though, on how markets in Asia are faring. It's been a few hours there since the markets open. Avril, what have you got your mind on?
Yeah, you talk about those fiscal shifts in the bloc, the German bond sell-off. The pain has certainly spread to the Asia-Pacific. If you're looking at the yield on Japan's 10-year, levels we haven't seen since 2009. Now, aside from that, Asia stocks are doing well today, extending gains from a day ago. And they're really running on this idea that, yeah, we don't have word yet about a tariff rollback for China, but for autos, for Mexico, Canada, potentially even agricultural products as well. That seems to be good enough for equities investors. So the region's benchmark, highest level in more than a week, meaning it has erased the losses from last Friday's crash. Chinese stocks also really doing well today, continuing to bask in the afterglow of the NPC, as our colleague Mary Nicola put it. Of course, she's from the MLive team. The Chinese tech names, particularly Alibaba, doing very well today. It just took the wraps off one of its AI models that potentially can rival its DeepSeek. So that's responsible for the big surge. Aside from that, we're going to be looking ahead to a briefing from top Chinese officials from the PBOC, securities, finance chiefs later today. Maybe some details on stimulus.
Thanks so much, Avro Hong in Singapore for us. We'll check back in with you in just a bit. Now, as we mentioned, President Trump is giving car makers a 1-month exemption from newly imposed tariffs on Mexico and Canada after pleas from industry leaders. He's also considering exemptions for some agricultural products. Bloomberg's Asia senior editor, Bill Ferries, is joining us now for more. So, Bill, how much of a shift in this is this in the strategy when it comes to tariffs?
Well, you know, we've seen it's a constantly evolving or shifting strategy from the Trump administration. So the latest is that auto imports from Canada and Mexico will be exempt for an additional 30 days. That came after President Trump heard directly from the heads of companies including Ford, Stellantis, and General Motors. So they're pushing that back. That, in theory, should give the companies time to try to find workarounds or to even announce new investment plans potentially in the U.S. that might buy them even more time. But the administration is signaling that those tariffs are coming in, not just on autos, but auto parts as well. But whether 30 days is enough to make those changes, we'll just have to see. It's a lot for the companies to adjust to, but they're doing what they can with a ground that's constantly shifting below them.
Is that why, Bill, you would say these auto companies have really come into focus? I mean, what was it? What was the pressure that they actually put on the administration to get this delay?
Well, you were hearing warnings from auto dealers themselves just around the country, as well as the executives at these companies saying, we've built our supply chain systems, our delivery systems around this North American trade agreement with Mexico and Canada. So they were bringing in large numbers of vehicles from Mexico, from Canada. And they said the reality is at the dealers' lots, you were going to see price increases of, at the minimum, a few $1,000s, in some cases more than $10,000 on certain models. There was a lot of panic in the industry that this was really going to shut down sales. It's obviously a huge employer in the U.S., has a huge outsized economic impact, and that seems to be something that's giving the Trump administration pause for now.
We will leave it there with Bill Ferries there, Bloomberg's Asia senior editor. Bill Ferries, thanks so much. Now let's get back to the markets. Asian stocks have followed Wall Street higher on Trump's tariff relief, while global bonds are under pressure in a sell-off triggered in Germany. Joining us now is Divye Arora, Daman Investments Head of Portfolio Management. Divye, really great to get you on. We were talking to our reporter earlier, Avro Hong, about how we're seeing Hong Kong and China stocks continuing to bask in the glow of the NPC. Are you among the bullish camp that wants to get into this pile-on right now?
Good morning, and thank you for having me on the show. Look, this year is going to be a tough year in general because we believe that volatility in the markets, global markets, will continue, and also in the Chinese market. Yes, the NPC committee was quite strong, and they delivered a good support to the economy. They talked about increasing the budget deficit from 3% to 4%. And if you look at the overall deficit, they're talking about now 10% because they want to issue some specialized bonds to improve the consumption in the economy and to invest also on the infrastructure. So we believe there is some impetus from that, that will come to the markets and to the economy. But in general, we are not very bullish on China because we feel that the property market issue is still not resolved. We need to see some bottoming out on the property market side. Consumer sentiment is still weak over there. Although the manufacturing data has come out much better recently. But yes, what we can think about is, or we can position in, is the technology sector, which has been doing well, especially after the DeepSeek's innovative model, which was built at a lower cost. So that kind of shows us that China is innovating, and the companies really have got the firepower to innovate. So we would be more bullish on the technology than the broader Chinese market.
How does that compare, Divye, with your outlook when it comes to U.S. equities? We were mentioning that we did see indices closing higher, potentially on this pause in tariffs. Give us your sentiment from the other side.
Look, when we started the year, investors were quite bullish about the U.S. equities in general. I think everybody was focusing on the positive side of Trump's policy, which is tax cuts and deregulation. But however, people ignored the reality regarding the tariffs. And when tariffs have become a reality, the volatility in the market has increased. So what we have done recently is that we are trying to reduce our weight in US, especially on the equity side, and try to take more exposure to the international markets. At the same time, take further exposure towards the bond markets. We believe that the bond yields are still, pretty much high on the absolute basis. So that's a good hedge against the equity volatility that we're going to see linked to tariffs this year. But at the same time, we are not seeing any kind of a recession coming into US. We are still seeing that consumer is strong. The economy should grow between 1.5 to 2%. So we are still maintaining our overweight position on the US equities. But we are cautious that this year, at least for the next. So this few months, we will see some volatility. So this few months, we will see some volatility. And because of that reason, we want to be more diversified. We want to be more S&P equal weight focused rather than more, S&P only tech focused. So that's what we have been doing from last 3 to 4 months in our portfolios.
Divye, talk about your interest then in the global bond market, because we mentioned that we saw the sell-off continuing. It's continuing right now on Wednesday, really triggered by what is happening globally, but then also in Germany. Do you still stand by your stance to be overweight in bonds?
So we are overweight in equities, and we continue to remain overweight in equities. What we have only done is that from reducing the volatility in our portfolios, both global and regional, that we have cut down the overweight in the equities, but we are still overweight equities. We are underweight bonds because we believe that in the near term, there could be an inflation scare that we can get. And also, the inflation has been a bit sticky, right? So from that purpose, we think that the yields might have bottomed around 410 levels on the 10-year. And we might see the yields rising back towards 430, 440. But in the nutshell, bonds could be a good diversification if the volatility continue in the markets.
Where then, Divye, where are you looking to increase your weight in bonds?
Yeah, so what we have done is that we have looked at some of the, a mix of investment grade and the high yield issuers. So we have seen there are a lot of issuers there in the Middle East region, which are giving us anywhere between 6 to 8% yield. And the fundamentals are very solid over here in the GCC markets. So you have likes of, the MENA real estate players. You have likes of the MENA banks, which are issuing POPs. And there's a lot of demand because the economy here is very strong. So we are trying to focus more on the MENA bonds, both investment grade and both high yield at this moment.
I see. Good place to leave it. Divye Arora, Head of Portfolio Management at Daman Investments there in Dubai for us. Great to speak with you. Now, also, Bloomberg has learned that the Commerce Department is tapping former Morgan Stanley banker Michael Grimes to lead a planned U.S. sovereign wealth fund. Sources say Grimes is leaving the bank after 30 years to head up the new wealth fund, part of President Trump's effort to give the U.S. a stake in projects he considers critical to national security. Now, coming up, President Trump is warning Hamas of hell to pay if it doesn't release Israeli hostages. The details on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. President Trump is warning Hamas there will be what he describes as, quote, hell to pay if the militant group doesn't immediately release Israeli hostages held in Gaza. In a social media post, Trump warned this is his last warning for Hamas. Trump's warning comes after Trump's top hostage negotiator met with Hamas officials in Qatar in a rare instance of direct contact by U.S. officials with a designated terrorist organization. Joining us now is Stuart Livingston-Wallace, Bloomberg's executive editor for Middle East, North Africa, and Russia. Stuart, great to get you on the show. Talk about how this warning will potentially derail negotiations or impact negotiations more broadly.
Yeah, good morning, Jen. So, I mean, it is incredibly unusual on two fronts. I mean, in terms of a US president coming out onto social media and issuing this kind of warning this starkly. And remember, it's not just to the Hamas leadership, it's to the entirety of the group, which still has something of a presence in Gaza. I mean, it does make the negotiations somewhat more difficult, at least on one side. And in terms of the Israeli reaction, clearly they've been told about these discussions that have taken place in Doha, where Hamas has a political office, with the blessing of previous US administrations. But nonetheless, it definitely complicates it because it ramps up the rhetoric. On the other hand, you might argue that, phase one of the ceasefire ended on Saturday. The discussions for phase two hadn't even started. It felt like nothing really was happening. And you did have Israel obviously preparing again to enter Gaza in force if it needed to. So you could argue that maybe this provides some momentum to get things going again. But Hamas came out pretty quickly afterwards and said, this was in contravention of the ceasefire agreement they'd already reached. And that at least as of this morning, it didn't feel like there was going to be any immediate response to that warning issued by Trump.
Well, and we also saw, Stuart, reportedly Trump's top hostage negotiator meeting with Hamas in Doha. Is there progress likely to come from this? What do you make of this meeting?
I mean, to some extent, it's unprecedented. Now, we've been quite cautious, but I said it's a rare meeting because, we couldn't really think of many examples, or really any examples, where that had happened. I mean, it is by and large the policy of the US government not to talk directly to any group that it is designated as a terrorist organization. And Hamas has been on that list for a very long time. So it is incredibly unusual. However, I think to some extent, it demonstrates the Trump administration's intention here. You have something like, well, more than 4 dozen hostages still held captive, of which probably a couple of dozen are still alive. And I suppose to some extent it shows this mounting frustration that we're not making any progress in terms of taking on that sort of second phase of the ceasefire, the release of more hostages, the release certainly of the dead hostages and their bodies back to Israel. So again, to some extent, it's sort of ramping up that rhetoric. It's showing that heightened sense that things have to move forward. We can't stay where we are as things stand.
Yeah, absolutely. Stuart Livingston-Wallace, Bloomberg's executive editor for Middle East, North Africa, and Russia, joining us there in Dubai. Stuart, thanks so much for joining. Now, coming up, we'll discuss the challenges and risks to China's ambitious economic goals as investors look ahead to a key finance briefing in just a few hours. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Now, China's finance and securities chiefs will hold a news conference in just a few hours as the nation sets an ambitious growth target despite U.S. tariffs. Asia government and economy correspondent Rebecca Chung-Wilkins is joining us now for more. So, Rebecca, what can we expect from this briefing?
Well, it's quite a host of different figures that we're expecting to hear from. So securities, regulators, various heads of different ministries. And really, they'll all be talking about how it is that their own institution is going to contribute to some of those big goals that were outlined in yesterday's MPC work report. So, for example, the emphasis on trying to create a national unified market, on reducing barriers to entry, increasing and encouraging more foreign investment. What kinds of implementation or what kind of mechanisms might be used to encourage all of that. There's also, of course, still continued focus on the PBOC, particularly in light of the tariff threats that we've seen so far. Their focus has very much been on stabilizing the currency, but there now also is this need to introduce more, potentially some kind of easing, particularly to try and help meet some of those goals. Of course, we had various stimulus announced in the form of special sovereign bonds and so on that we're also expecting to come through. Now, a lot of the actual numbers that we saw in the work report were sort of very much within consensus. There wasn't anything that particularly, I think, surprised many economists, so no sort of big bazooka stimulus. But instead, there was this real sharp focus on consumption. So again, when we're looking at these briefings, we're really looking to see whether ministries in particular are following up with policies on and where the implementation might come.
And Rebecca, we mentioned earlier how we're seeing both Hong Kong and China stocks still basking in that glow of the NPC meeting. But what are the challenges here? What could potentially rattle the markets?
Well, the big issue, of course, is the obvious one, which is the tariffs that we've seen come through. So an additional 20% coming through from President Trump, that adds to about 10%. So we're talking now about a base of 30 to 40 economists start to estimate. And that is already starting to bite. So the real issue is how do we get to that really quite ambitious target of around 5% in light of that? Now, China's answer is this #1 priority focus on consumption. It's the first time we've seen the work report outline that focus. And you can see that reflected in the numbers here, this shift away from high-quality development. Now, this phrase, high quality, still is a mantra. They talk about high-quality education, for example. But really, it's about how China is going to unleash the consumer. People in China have been very cautious about spending because of that property crisis, because of stagnant wages. And China itself, Beijing's mindset, they've been quite hesitant on introducing what would be very costly demand-side moves to reform the economy. Instead, they've stuck to sort of supply-side techniques. Now, whether or not we see that shift is really the big question. Are we going to see more expensive, costly reforms to social welfare, for instance, so that people feel safer, they're not saving? There's an enormous amount of household savings that potentially could be unleashed, but that a lot of people are sitting on because they're scared about maybe something happening to their property values, they're scared about losing their job, they might be scared about high medical costs. And so the Chinese consumer is sitting on this huge chunk of change. And the key for Beijing really is to figure out how they can unleash that.
Great coverage as always. Bloomberg's Asia, government and economy correspondent Rebecca Chung-Wilkins joining us there. Thanks, Rebecca. Now, here's a look at some of the other stories we're following this morning. French President Emmanuel Macron says he will open talks on using his country's nuclear capabilities to defend European allies. The remarks come ahead of an emergency meeting of EU leaders in Brussels for talks on Ukraine and the continent's wider security. Macron says his decision also follows a request from German Chancellor-elect, Friedrich Merz. Another Bloomberg scoop we have this morning. We've learned that Klarna Bank is set to file publicly for its first U.S. IPO as soon as next week. The Stockholm-based payments business aims to price the offer in early April and is targeting a valuation of more than $15 billion. Klarna is working on the listing with around 15 banks led by Goldman Sachs, JP Morgan, and Morgan Stanley. Apple has rolled out updated MacBook Air laptops and Mac Studio desktops with new processors, cameras, and features. The new MacBook Air starts at $999 and features a speedier M4 processor. The Mac lineup performed better than expected during the holiday season and helped offset sluggish demand for the iPhone. And New York's Warburg Pincus and Saudi Arabia's $320 billion pension fund manager Hassana are to jointly explore deals in the kingdom as the global private equity firm looks to boost its presence in the Middle East. The companies say their agreement will explore investment opportunities that contribute to the long-term growth of Saudi Arabia. Now, coming up, the U.S. has decided to stop providing some intelligence to Ukraine. Details on that next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. The bond blowout goes global. Japanese benchmark yields soar to their highest in more than a decade after Germany's spending plans send 10-year bonds tumbling the most since 1990. The U.S. slams the brakes on tariffs, agreeing a 1-month exemption for the autos industry. Now, the Agriculture Secretary tells Bloomberg a carve-out for some farm products is also being considered. Plus, Bloomberg learns the U.S. has frozen some intelligence for Ukraine, escalating its standoff with Kyiv. It's just gone past 8:30 a.m. across the Emirates, 6:30 a.m. here in South Africa. I'm Jennifer Zabasadja in Johannesburg. Plenty of geopolitical news to get to, as well as market-moving news. Let's just get to where markets are positioned ahead of the trading day. If we take a look at where U.S. equity futures are right now, pulling back ever so slightly after quite a turbulent session on Wednesday, we saw an early drop from many of the U.S. indices before we saw quite a turnaround, closing higher as traders then began to parse through this exemption that we got on these trade tariffs from the Trump administration. We actually saw the S&P snapping a two-day losing streak, but now, as you can see, marginally down right now. We mentioned the global bond sell-off right now. Uncertainty is really the picture here playing out in the global bond market, as is the new decision by Germany to increase their spending on defense. We saw German bonds actually ending Wednesday with the worst day since 1990. Right now, we are seeing the sell-off continue with German bond futures down just about 0.7% there. Although what we are seeing potentially a benefit for emerging markets and the situation happening in the U.S., potentially beneficial to emerging market indices. Right now, we're seeing the emerging markets index actually up by more than 1% there. And a lot of the sentiment is potentially a lot of the concern about U.S. economic growth and the changes in fiscal spending in Europe is potentially shifting capital flows to other markets. And finally, Brent crude right now up just over 0.5% to trade at about $69.68 a barrel. We are getting some insight, though, from Morgan Stanley, lowering their crude forecast, their Brent crude forecast for the end of the year as we see crude prices changing. And let's just dig into our terminal chart. That is on foreign exchange, especially as we take a look at the euro's recent rally. We've seen the currency up over its 200-day moving average compared to the U.S. dollar, as this chart is showing. And the currency's current three-day rally is its best since 2015. Many investors now thinking potentially we'll see the currency continuing to rise, maybe just over 10% in the coming few months. Let's, though, check in on how markets in Asia are faring. We're waiting there for a press conference from officials, but Avril Hong is standing by in our Singapore studio with more. Avril, what have you got?
Yeah, I think you're referring to the China briefing, but let's zero in on assets in Japan. As you say, there's a lot of selling in German bonds. That's certainly the pain being seen that spread to Japan. If you look at the yield on the 10-year levels we haven't seen since 2009, but even as we see the selling in bonds, Japanese equities are faring positive today. The idea that we're getting tariff reprieves, even if it's not for China just yet, for Mexico, for Canada, that seems to be enough for investors. The steel-making related stocks, those are the ones that are lifting the benchmark today. I'd also highlight what's happening with 7&I. Of course, after its take-private talks collapsed last month. This is a company that's been trying to boost valuations. We're since hearing that it could engage in a large-scale share buyback, so revving up almost 10% there. Other than that, the yen rally today also taking a bit of a breather, but we also have the likes of BNP Paribas Asset Management saying they see as much as a 15% climb on the yen to 130 levels. We could see highs as much as that. It's not just about inflation looking more sustainable in the country, heightening bets of further hikes from the BOJ. It's also about safe haven demand amid global tariff uncertainty, Jen.
Thanks so much, Avril Hong in Singapore for us. Now let's turn back to our story in the U.S. The U.S. has stopped providing some intelligence to Ukraine that helps them target Russian forces. Meanwhile, the Ukrainian president's top aide will meet with the U.S. soon to resume discussions about peace and security after the volatile meeting between Presidents Trump and Zelensky strained relations. Joining us now is Henry Meyer, that's Bloomberg's senior reporter in Dubai. So, Henry, has some progress been made between these two parties towards mending the relationship between Trump and Zelensky?
Jennifer, I mean, I think we're at a very critical moment now, and the decision on suspending some intelligence sharing is a very serious one that really shows you how bad things have gotten. I mean, just want to stress that for Ukraine, this has been an absolutely vital part of the war effort, and the suspension of the U.S. weapons deliveries, in addition to this, is really going to weaken Ukraine's position on the battlefield. Having said that, there are efforts underway to try and overcome this rift. President Zelensky, made an overture to President Trump. He said that he regretted what happened in the Oval Office, the blowout between the two of them. And he has said that he supports peace efforts that President Trump is currently undertaking. However, it appears that the U.S. administration wants more than just words from Zelensky. It actually wants him to actively participate in negotiations with Russia, until it's actually ready to lift these measures.
Henry, where is Putin in all of this? I mean, what have we heard over the past few days and how Russia is really responding to Trump's own overtures that he's put out there?
I mean, Russia, of course, sees this as very much working in its favor. The Kremlin spokesman Dmitry Peskov said a couple of days ago that the dispute between the U.S. and Ukraine is going to force Kiev towards peace. Having said that, the position that Russia has is very far from what Trump is asking for. Trump wants to see a ceasefire happen quite quickly. He's also in favor of the deployment of European peacekeepers. And this is something that Russia has said it's completely against. So I think what we're going to see once Ukraine and the United States reach some kind of an agreement, Trump will probably switch his focus to Russia, and that's when you could actually see much more contentious negotiations and contacts taking place between Russia and the United States.
Henry Meyer, Bloomberg senior reporter in Dubai. Henry, thanks so much for your reporting. Let's continue this conversation with Sorana Parvulescu, EMEA partner at Control Risks. Sorana, great to get you on the show. So we just heard from our Henry Meyer that this is a critical moment that we're in right now. How would you describe it?
Yeah, it is. I mean, we're trying to cut through the noise in many ways and look at the long-term sort of positions. And as Henry was saying just now, the truth is that we have a long way to go until any form of peace. The sides are very separate. And yes, the US administration has put a lot of pressure on Ukraine, which ultimately has given an advantage to Russia and Putin. I think Putin will take its time and play their game because it is in their interest, and they see that they now have an advantage both on the ground in terms of military capacity, but also in sort of international relations more so than they had a few months ago. They'll play the game, but they'll also be cautious. I mean, they know what happened with the talks on North Korea in the first Trump administration. There is no guarantee that this will sort of lead to a substantial deal. And to be clear, Putin, there's no guarantee that Putin wants a ceasefire. The assumption is that he does, but he's not achieved his minimal military objectives in Ukraine. Definitely not what he intended to when he started the war. He's got to present a win back home on the domestic front, and he won't accept any type of humiliation or sort of what may look like a humiliation when if the talks begin.
So, Sorana, who or what potentially changes the calculus here? I mean, we've heard the EU is deciding to increase defense spending. Could this potentially mark a shift in the direction talks are moving in?
I mean, it certainly provided finally the impetus for Europe to kind of get acting on this. There are things they can do to plug the gap, particularly, for example, well, on intelligence, we'll have to see how much of the gap they can plug. As far as we can tell, not everything. But I'm sure the Ukrainians will adjust with help from Europeans. On the military aid, equally, the Europeans are trying to find the funds and sort of in the short term, I'm talking about find the funds to continue to buy US equipment to transfer to Ukraine. And that we're watching as to whether the conversation around freezing using Russian frozen assets as war reparation will go any further. So there's short-term sort of efforts they're making to just make sure that Ukraine can resist and can put up resistance on the front for the duration of 2026. And our scenario Control Risk is that most likely the conflict is going to continue well into 2026, based on the capacity of both militaries and what they can put together. Europe can come in and help to some extent. The long-term question is, or sort of medium to long-term question is more critical because the capacity of the industrial defense complex in Europe, and sort of the issues around funding and so on have not been resolved, and would likely take a lot more to resolve, even if we find the political will to do so. So that is quite critical. But the expectation is that this is going to drag on for at least months to come.
Sorana, let's pivot to what's happening in the Middle East. We were speaking earlier about how we're now seeing President Trump ratcheting up the rhetoric, saying that Hamas will have hell to pay if they do not return some of the hostages. We also saw a number of Arab nations coming together, proposing their own plan that we heard the Trump administration decided not to move forward with. Were you surprised that the Trump administration did not agree to this Arab plan for Gaza?
No, not really, though. We were surprised the message came so fast, then again, and so resolute. Then again, this is how we roll right now, right? We weren't surprised because the deal, I think the summit brought a few messages, made a few clear messages. One is that there is absolute Arab unity on the fact that the Palestinians cannot be should not leave Gaza, and two, that the solution for Gaza should also include a sort of, or should acknowledge the issue of the two-state solution and sort of consider the West Bank as well. And those points remain, I think, and will probably come to the fore again. We were not surprised that the U.S. administration would reject it, because the declaration lacked detail on what would happen to Hamas, and that is the critical point, the critical issue that is unresolved right now, both for Israel, who will not tolerate any form of sort of reconstruction or solution for Gaza that involves a role for Hamas, both military and politically, and also clearly now the U.S. has made that very clear as well.
All right, we have to leave it there. Could speak to you for quite some time, but we unfortunately ran out of time. Sorana Parvulescu, partner for EMEA at Control Risks. Really appreciate your insights, Sorana. Now, Bloomberg understands that Goldman Sachs and JP Morgan are among banks acting as brokers to facilitate growing investor demand for ways to trade Russian-related assets. Contracts, a trade that's allowed under Western sanctions. The ruble has jumped some 20% this year, the biggest increase in the world. And coming up, the Democratic Republic of Congo offers the U.S. exclusive minerals access. Next, this is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. The Democratic Republic of Congo has offered the U.S. exclusive access to critical minerals and infrastructure projects in exchange for security assistance. This comes as it battles Rwanda-backed M23 rebels along its eastern front. Bloomberg's Ndiro Oganga joins us now from Kigali. So, Ndiro, we know that Congo is rife with resources. What exactly are they offering to the U.S.?
Hi, Jen. So on top of exclusive extraction, they're also offering export rights that will ensure direct and stable supply to key industries in the U.S. like technology and also defense. What's also on the table is the operational control of banana deep water development, ensuring American oversight of the mineral export hub. They're also willing to partner with America to ensure that they develop a strategic stockpile of Congolese minerals that will go a long way in enhancing not only economic but also security resilience of the United States of America. And in a letter that the DRC sent to the Secretary of State, Marco Rubio, they say that the country has 24 trillion in terms of untapped natural resources, including critical minerals, and they supply 70% of the world's cobalt that is critical for aerospace and also defense industries, plus other tech-related industries. And they also say that they have some of the largest deposits of lithium, tantalum, uranium that are vital for the next generation of military application and also energy independence. And where the U.S. comes in is America has identified 50 critical minerals, and DRC has large deposits of 10 of those. On the 20th of January, we saw President Donald Trump signing the Unleashing America Energy Executive Order, which made securing some of these critical minerals a little bit easier because they'll be made a priority. And so by allowing access, what the DRC does is it ensures that the U.S. has stable supply, but also goes a long way in reducing Chinese influence in the mining industry in the country.
Yeah, and it's interesting timing given the U.S. is looking to Ukraine, too, for minerals. Indira, when we talk about the fighting in the eastern DRC, how is that affecting mineral exports right now?
Jen, for starters, the perception towards Rwanda is becoming more and more hesitant. We've seen the European Union lawmakers say that it's time that the Union reconsiders the $935 million mineral deal it has with Rwanda. So that's a starting place. And other countries are going to become more and more hesitant in buying minerals from Rwanda. As at the moment, there are no sanctions. So anyone is free to buy, but the perception of the country is tainted globally because of the fighting that is going on in the DRC. And the country is saying that Rwanda is stealing its minerals, smuggling them and laundering them into the global ecosystem. This is also an opportunity for the Democratic Republic of Congo. They can set their house in order. There have been some American companies that have worked in DRC, but they've exited. While these companies had their own problems, for example, they were heavy in debt. DRC is a difficult market. You'll have people complaining of corruption, legacy infrastructure issues. The fighting did not start right now. The eastern region has always been a very volatile region. So this is an opportunity not only for DRC in terms of the mineral, but also investors. And if they have American investors come in, then this will be a stamp of approval and open them up to many other investors that will be willing to look into their mining sector.
Certainly. Great reporting there. Bloomberg's Indira Oganga in Kigali for us. Indira, thanks so much. Now, a quick look at some of the other stories we're following this morning. Security forces in South Sudan have detained the nation's petroleum minister a day after the arrest of a senior military official amid escalating tensions in the oil-exporting East African nation. The seizure of the two officials, aligned with the country's vice president, comes amid clashes between government forces and armed youth from his ethnic group known as the White Army. Plenty more news ahead. Stick with us. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Arabian Construction Co is the latest firm to consider an IPO in the UAE. The Abu Dhabi-based company is looking to capitalize on the country's booming property market, joining its rivals such as Aldar Properties and Emaar in going public. Bloomberg's Laura Gardner-Cuesta is joining us now for more. So, Laura, walk us through this deal and what we know about it.
Hi, Jen. Thanks so much. Yes, so essentially ACC is the latest UAE IPO candidate. We have reported that they are in touch with banks with a view to listing in the UAE at some point. They're looking to raise a few $100 million from what we understand. And this is the latest company in the construction sector to consider going public. We've previously reported that Alec Construction, which is a company backed by the Dubai government, is also looking at going public. And this is on the back, of course, of huge demand for real estate at the minute in the United Arab Emirates. We've seen population grow under really liberal visa policies. And of course, the fact that there's no income tax has attracted a lot of professionals and people to the Emirates. And we've also seen a number of financial firms move to the country. So it's also created a lot of demand for office space. So it's a really booming sector at the minute, and it's obviously expected to lead to a few listings in the sector.
Talk more about that, Laura, if you can, and what we're seeing more broadly when it comes to IPOs in the GCC.
Yeah, so right now we've just entered the month of Ramadan, so it's expected to quieten down a little bit. We are meant to be seeing some listings happening this month from Saudi and the UAE and Oman, so some companies that have already priced their IPOs and will start trading during this month. But I think sights are firmly set now on the post-Ramadan issuance window. And with that in mind, a lot of people are watching the Etihad IPO, which some people expected would happen in February. Now looks like it will happen a bit later. And this will be the first Gulf carrier to go public. It's obviously Abu Dhabi's national carrier, and they're coming up from an impressive turnaround that has seen profits surge. So it'll be a really interesting deal to watch.
All right, Bloomberg's Laura Gardner-Cuesta there joining us in Dubai. Laura, thanks so much for joining. Great to have you on. Now, here's a quick look at some of the other stories we are following. 7 & I Holdings has surged on a Bloomberg scoop that the Japanese group is planning a large-scale share buyback. We understand the board will vote on the buyback plan, which could amount to more than $13 billion at a meeting to be held later today. The retail group has been trying to find ways to boost its valuation after a plan by the founding family to take the company private collapsed last month. First Abu Dhabi Bank is pursuing a sweeping internal reorganization, the latest effort to position the lender as the Gulf region's leading financial franchise. According to a staff memo seen by Bloomberg, FAB is set to have 4 major business lines: investment banking, wholesale banking, personal, wealth and business banking, and international. Now, let's just take a quick check at where the markets are positioned ahead of the trading day right now. We are seeing U.S. equity futures pulling back. But as we mentioned at the top of the show, we did actually see the S&P snapping a 2-day losing streak, potentially on that news about a pause in tariffs for automakers in the U.S. Eurostock 50 futures up more than 0.6% there. A lot of focus is being paid to what is happening in Europe. And of course, we will get the ECB meeting later today. And let's just take a quick check at oil as well, because crude oil right now is edging higher. Right now, we're seeing Brent crude up just about 0.6% after we have seen Brent crude tumbling over the past few days, but still trading at just about $69.72 a barrel. Now, coming up in the next hour of Horizons, Hugh Chung from Endowus joins us to discuss his market outlook. I'm Jennifer Zabasaja in Johannesburg. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. The bond blowout goes global. Japanese benchmark yields soar to their highest in more than a decade after Germany's spending plan sent 10-year bonds tumbling the most since 1990. The U.S. slams the brakes on tariffs, agreeing a 1-month exemption for the autos industry. Now the Agriculture Secretary tells Bloomberg a carve-out for some farm products is also being considered. Plus, President Trump warns Hamas there will be quote, hell to pay if it doesn't immediately release hostages from Gaza. We'll bring you all the latest from the Middle East. But good morning to you. It is just gone past 9 a.m. across the Emirates, 7 a.m. here in South Africa. I'm Jennifer Zabasaja in Johannesburg. Welcome to the second hour of Horizons Middle East and Africa. And quite a bit of geopolitical news, as we mentioned, to get through. The markets parsing through that, in addition to a press conference that we're waiting for following China's NPC meeting, and of course the ECB meeting coming later today. But let's just take a look at where markets are positioned ahead of the trading day. If we start right now with U.S. equity futures pulling back after we saw quite a turbulent session on Wednesday. We saw an early drop in U.S. indices to start the day before a rebound, seeing all of the major indices actually closing higher as we did get this news about the 1-month tariff exemption for major automakers. The S&P actually snapping a 2-day losing streak, but right now not doing too much, marginally down. The story, though, about uncertainty playing out in the global bond market, as we mentioned. We mentioned a historic sell-off, especially for Germany right now. We saw German bonds ending Wednesday, its worst day since 1990, as we mentioned there. Right now, if we take a look at German bond futures, continuing that sell-off down more than 0.7% there. But a lot of this expectations around potentially a slowing U.S. economy economy, shifting fiscal priorities in Europe, and rising tariff pressures, potentially a boon for emerging market equities. If you take a look at the MSCI Emerging Market Index, up more than 1%. And we also saw EM currencies and bonds getting quite a lift, potentially as investors shifting their capital flows from some of the other markets. And finally, Brent crude edging higher, up just about 0.6% there to trade at about $69.71 a barrel. And yet we're hearing from some investors and analysts, including Morgan Stanley, lowering their forecast for the rest of the year for Brent crude as we see a mounting uncertainty hitting a lot of these assets. Let's just dig into our terminal chart, though, and that is on foreign exchange. We mentioned we are waiting for the ECB later today, but we've seen the euro's recent rally nudge the currency up over its 200-day moving average compared to the dollar, as this chart is showing. We're actually noting that the currency's best three-day rally is the best since 2015, and many investors are betting that the rally will continue, putting in their bets that we'll see potentially 10% growth in the coming few months. But we'll watch closely what this pair does. Let's check in, though, on how markets in Asia are faring. Avril Hong is standing by in our Singapore studio. Avril, what are you watching?
Yeah, Jen, the bond pain in Germany has certainly spread to this part of the world. So highlighting first what we're seeing in Japan as well as the Antipodean region. Certainly, there is a lot of selling underway. And I think one portfolio manager from 5-Star Asset Management put it best. Trump has kickstarted a historic shift in economic and defense policies. And until we get clarity on the direction of that shift, it's really hard to be bullish on bonds or take strong positions on them. So today we're seeing the yield on the 10-year in Australia, 13 basis point move. This is something we haven't seen since October. Now, amid all this, it's really interesting. Our China credit team is flagging Chinese bonds as potentially for global bond investors a sort of safe haven. Yes, we've seen in the past month or so the bond rally there taking a bit of a breather as stocks charged ahead. There was also a domestic liquidity crunch, but things are stabilizing now. And then don't forget, China's NPC has also been reiterating monetary easing to come. So maybe more positives for Chinese bonds. We're back from the lunch break in China. Hang Seng also looking at those gains from the morning session, hanging on to them about 2.8%. A lot of this fueled by tech. Jen.
Yeah, of course. Avril Hong in Singapore. We'll check back in with you in just a bit. Let's turn back to the U.S., though. President Trump is giving car makers a 1-month exemption from newly imposed tariffs on Mexico and Canada after pleas from industry leaders. He's also considering exemptions for some agricultural products. Bloomberg's news desk editor, Jill Desis, is joining us now. So, Jill, automakers getting a bit of a whiplash, as is the rest of the market, from the stop-start of these tariffs. Walk us through what we know now.
Yes, that's right, Jen. I mean, ultimately, what we're seeing here, it seems, is some additional sort of negotiation before the brunt of these tariffs take effect. There are key, industry executives from Ford, Stellantis, GM that met with the Trump administration ahead of this delay. It seems that a lot of the discussion here was about, can they have some additional time before these tariffs go into effect to sort of shift production back to the U.S. We already know that a lot of these companies have pledged, upwards of billions of dollars to start shifting production ahead of when these are going to affect. Not sure how much extra time a month is going to really give them. But, I mean, look, the truth is here that the impact from these tariffs has been going to be enormously stressful on a lot of these companies. We've seen reports that you could see increases of upwards of $12,000 for the cost of some cars, particularly EVs. So we're looking at a lot of stress that's happening on these supply chains. Were these to go into effect right now, they're getting a bit of a reprieve. We have seen the market react to that, somewhat favorably. But again, it's not off the table entirely yet. I think there's still a lot more to come. But I think this really just does kind of show how quickly, how fast moving a lot of these developments have really been.
Yeah, and Joe, we are hearing from Canada and Mexican authorities about the speed at which this is all moving. How would you assess their response to this?
Well, look, at this point, Canada in particular has essentially said, they announced some reciprocal tariffs that are on the way. They've said until everything is removed here, we're not actually, taking these tariffs off the table. That first round may be a bit negligible in the grand scheme of things, but there's actually a second tranche of Canadian tariffs that are set to go into effect that could hit things including automotives, steel, aluminum, so some really, really big heavy-hitting industries. So that does just kind of show you that, these other countries, really American allies here, are trying to hit back on these tariffs, see what kind of negotiation room that they can have. I think it really, again, just does open the door for, potential, maybe this results in carve-outs, maybe this results in some rollbacks. We'll have to see. But it does seem like there's certainly a pressure campaign kind of ratcheting up here on both sides. What Trump ultimately wants here, according to him, is some kind of change in terms of border security, immigration, fentanyl, these kinds of things. That's really what he's been trying to exact from these types of negotiations, but it does kind of just show you that there's still a lot of uncertainty going on with these tariffs, and there's certainly a lot of political pressure that's starting to build up on both sides here.
Yeah, Bloomberg News Desk editor Jill Desis. Jill, great to get you on. Thanks so much for joining us. Let's get back to the markets. Asian stocks have followed Wall Street higher on the latest tariff relief, as we were just speaking there with Jill, while global bonds are under pressure in a sell-off triggered in Germany. Joining us is Hugh Chung, the CIO at Endowus. So, Hugh, let's just start with a lot of the stop-start of tariffs right now. How are you wading through what has been quite a tumultuous few weeks since this new administration has kicked in?
Yeah, good morning, Jen. I think the really large impact of tariffs has been felt on growth as opposed to inflation. So one of the things that's really happened over the last 2 weeks has really been a repricing of U.S. growth. And because of that, you saw dollar weakness, you saw Treasury yields come down, and the markets have come off as well. So there's definitely evidence that consumer sentiment, as well as other consumer numbers, are starting to soften. And so really the impact of the uncertainty of tariffs are actually being felt more on growth than inflation at this point.
Does that make you concerned then moving forward, Hugh? We were speaking to a guest earlier who said the focus is more on inflation, not so much U.S. economic growth. What does that mean moving forward and for your asset allocations?
Yeah, I think, it's what's really important from an implication perspective is really diversification. I think we've gone through a period of time when there was a lot of U.S. exceptionalism. If you go back 2 months ago at the Goldman Macro Conference, 58% of the participants were saying U.S. will be the best performing market again this year. But in reality, of the first 2 months, HSCEI is up over 20%. Europe is far outperforming the U.S., and the non-tech sectors are outperforming tech. So it really shows you the importance of diversification, and also the bonds have actually been a pretty difficult place to be over the last few years. But we're talking about European bonds just now, but in the U.S., bonds have actually done quite well year to date. So it really raises the importance of diversification away from just U.S. equities. And as we see this growth scare or repricing of growth happen, I think that brings back the importance of having a really diversified portfolio across assets and regions.
Hugh, when we talk about diversity, or diversification, I should say, does that for you move into Asian assets? We mentioned we're waiting for this NPC briefing happening later today. Considering what we've gotten from the meetings this week, are you considering shifting?
Yes, absolutely. I think, again, I think when I mean shifting, I mean to have exposure, at least, with the weights that the global weights, the MSCI, weights would suggest. Doesn't necessarily mean to necessarily go overweight, but I think a lot of people have been underweight, and I think it does make sense to have assets in Asia. And even though the economic situation is really different by different regions, China, for example, is still going through a very weak economic cycle. Valuations are very supportive, and as you can see from the kind of bifurcated performance of tech in China right now, because valuations are cheap, a small kind of trigger can actually trigger these kind of rallies. So I think both from a diversification perspective, but also from the fact that valuations are very supportive, I think one needs to have exposure to these markets.
Hugh, let's just finish on Europe. ECB meeting happening later today. The expectation largely is for a cut. We're seeing equities in Europe outperforming, as is the euro. Do you have a stance on where you think the euro will go, and will it be at the expense potentially of the dollar then?
Yeah, I think it's really, to me, less of a euro call, more of a US dollar call. And I think as we see this kind of repricing of growth, it's quite possible near term that euro continues to be strong. But I think the fact of the matter is the European economy itself is still, pretty weak. And I think really depending on which region, it could be different. But from an ECB perspective, for today, there's definitely going to be a cut. And I think there's going to be more cuts to come throughout this year, given the economy is still in poor shape. So from a euro perspective, I think it's really a relative call on the dollar. And because of what's happening to the dollar, euro could continue to be strong in the near term. But I think what's reflective of fundamentals, it's very hard to see very strong euro performance over a long-term period.
We'll wait to see how that plays out. That's Endowus CIO Hugh Chung. Hugh, great to get your insights on. Thanks so much for joining us. Coming up, Trump is warning Hamas of hell to pay if it doesn't release Israeli hostages. The details on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. U.S. President Donald Trump is warning Hamas there will be what he described as, quote, hell to pay if the militant group doesn't immediately release Israeli hostages held in Gaza. In a social media post, Trump said this is his last warning for Hamas. This after Trump's top hostage negotiator met with Hamas officials in Qatar in a rare instance of direct contact by U.S. officials with a designated terrorist organization. Bloomberg's Dan Williams is joining us now from Jerusalem. So, Dan, hard to see that this warning will potentially bring everybody to the table. But what do you think the impact will be here?
Well, it seems that Trump is pursuing a bifurcated strategy, as you noted, holding what appear to be unprecedented direct U.S. talks on a limited basis, at least with Hamas, while really upping the ante rhetorically. We heard him threatening hell to pay for Hamas just a few weeks ago. Now he's threatening that there would be hell to pay, and he's actually making a direct, more personal threat to see the death of every Hamas member should they not deliver the hostages immediately. Now, on the one hand, perhaps he thinks this could work. Perhaps he thinks this is a creative way of getting Hamas to deliver the hostages, of wrapping up this now 17-month-old crisis and war. It could be a sign of running out of options. Indeed, holding talks with a group in a manner that other administrations may not have done would appear, on the one hand, creative, perhaps on the other hand, a sign of vexation, of a lack of ideas. And I think now we'll have to see how Hamas responds. Its earliest response, its initial response, appeared to be returning to its form and saying that it wants to pursue ceasefire talks with Israel on its terms. There doesn't appear to have been much movement. We'll see how things play out during the day.
And yet, Dan, we are seeing Trump's top hostage negotiator meeting with Hamas in Doha. Earlier, our Stuart Livingston Wallace called this unprecedented. How would you characterize it?
I think Stuart is absolutely right. And I think we already know that President Trump is iconoclastic. He doesn't really rest on niceties or perhaps the norms of previous administrations. And he may have just thought this was a simple matter of finding out directly what the adversary wants in order to reach a deal. It's unclear whether Israel is happy with this. The indications are that it's not. It would worry about effectively an unraveling of a 3-decades-old arrangement common throughout the West. An understanding or an agreement that Hamas has to be sidelined as an obstacle to peace, as a terrorist group. On the other hand, if Trump manages to dislodge these talks, at least with the release of hostages that have dual U.S. citizenship, that might be a way into loosening up a wider deal. So I think everyone's waiting to see how that plays out. And again, Israel is itself reserving the option of going back to war in Gaza to release these hostages. So it will welcome the president's statement that it now has everything it needs, in Trump's words, to finish the job.
Bloomberg's Dan Williams in Jerusalem. Dan, always great to get you on. Thanks so much for joining. Now, shifting gears to the region here. Coming up, the Democratic Republic of Congo offers the U.S. exclusive minerals access as it battles Rwanda-backed rebel forces. The details on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. The Democratic Republic of Congo has offered the U.S. exclusive access to critical minerals and infrastructure projects in exchange for security assistance. This comes as it battles Rwanda-backed M23 rebels along its eastern front. Bloomberg's Ndiro Oganga is joining us now from Kigali. So, Ndiro, what is Congo offering exactly, and how might it pique the interest of U.S. officials?
Hi, Jen. So what Congo is offering is exclusive extraction and also export rights of critical minerals, and this will ensure direct and stable supply to key industries and sectors in the U.S. like defense and technology. What's also on the table is the operational control of banana deep water development, ensuring American oversight of key mineral export hubs on the African continent. DRC has also said they're very open to working and cooperating with the U.S. to build a stockpile of Congolese minerals to ensure economic and security resilience for the U.S. And in a letter that DRC sent to the U.S. Secretary of State Marco Rubio, they say that they have large reserves of untapped minerals worth $24 trillion. They supply the world with 70% of cobalt that is critical for aerospace, defense, and other tech-related industries. And also they have large deposits of lithium, tantalum, uranium that are vital for next-generation military application, but also energy independence. Where the U.S. comes in is the U.S. has identified 50 minerals, and DRC has 10 of those in large deposits, and they include tin, tantalum, uranium, lithium, and tungsten, just to name a few. And on the 20th of January, we saw President Donald Trump sign an executive order called Unleashing American Energy that is meant to prioritize securing critical mineral supply. So what this access by DRC does is it ensures stable supply for the U.S., but also goes a long way in reducing Chinese influence in mining in DRC.
Ndiro, at this point in time, do we know how the fighting is affecting mineral sale in the region, especially as you just outlined there, a number of resources that are there, but potentially what are the opportunities for some who are potentially not in the thick of it?
So at the moment, there are no sanctions yet, but the perception is becoming tainted and tainted by the day. And the more the perception becomes tainted, then the more hesitation comes in. Rwanda has come under fire, particularly from European Parliament, who have asked the Union to cease its partnership of $935 million mineral deal until Rwanda ceases cooperation with M23 rebels. Rwanda has been accused of backing these rebels, and there has been fighting in the eastern part of DRC. We've seen M23 rebels take parts of the eastern part of DRC, and there have been fatalities and also injuries. So this has tainted that perception. And we've also seen the Congolese President Felix Tshisekedi call on world leaders and tell them stop buying minerals from Rwanda. What they're doing is they're stealing our minerals, they're smuggling and laundering them into the global ecosystem. And when you buy from Rwanda, what you're doing is you're buying blood-stained mineral. Instead, buy directly from us. The other opportunity is if America takes this offer and gets into that market, then it will offer them an alternative to the Chinese partnership that they've had for a long time. American companies were previously in DRC, but it's a difficult market, to be honest. There have been complaints of corruption, legacy infrastructure issues, and also fighting. So the area has always been very volatile.
That's right. Bloomberg's Ndiro Oganga with the latest there. Ndiro, thanks so much for joining us. Now, let's take a look at some of the other stories we're following this morning from the region. Mali has stopped issuing permits for small-scale gold mining to foreign nationals after several deadly incidents. The measures include suspending artisanal mining permits and its seizure of any equipment used to extract gold at small-scale mines. This after at least 49 people, many of them women, were killed when a gold mine collapsed in the country's west last month. Security forces in South Sudan have detained the nation's petroleum minister a day after the arrest of a senior military official amid escalating tensions in the oil-exporting East African nation. The seizure of the two officials aligned with the country's vice president comes amid clashes between government forces and armed youth from his ethnic group known as the White Army. Police in Mozambique have fired on a key opposition leader's convoy hours before President Daniel Chapo signed a plan with other political leaders to end the unrest that's rocked the nation since October's disputed elections. A local group tracking the violence in Mozambique says more than 350 people have been killed since the vote. Now, let's take a quick check at your markets right now and how they're positioned ahead of the trading day. A bit sideways if we take a look at least U.S. equity futures right now, that coming after they largely closed higher after investors digested that temporary pause on tariffs, at least for automakers in the U.S., with the S&P actually snapping a two-day losing streak. Euro Stock 50 futures, though, looking like they'll start in the green today, up nearly 0.7% there. We are waiting for an ECB meeting to come later today with that. All right, now coming up, Bloomberg has learned Saudi Aramco is mulling a bid for BP's Castrol lubricant assets. We're live in Riyadh with the latest next. This is Bloomberg. This is Horizon's Middle East and Africa, our top stories this morning. The bond blowout goes global. Japanese benchmark yields soar to their highest in more than a decade after Germany's spending plans send 10-year bonds tumbling the most since 1990. The U.S. slams the brakes on tariffs, agreeing a one-month exemption for the autos industry. Now the agriculture secretary tells Bloomberg a carve-out for some farm products is also being considered. Plus, President Trump warns Hamas there will be, quote, hell to pay if it doesn't immediately release hostages from Gaza. We'll bring you all the latest from the Middle East. But right now, it has just gone at past 9:30 a.m. across the Emirates, 7:30 a.m. here in South Africa. I'm Jennifer Zabasaja in Johannesburg. Welcome to Horizon's Middle East and Africa. And as we mentioned, quite a bit of geopolitical news to wade through. Of course, it's the standoff with the U.S. and Ukraine. There's also a focus on German spending, as we mentioned there, making an impact on the bond market on Wednesday. But let's just take a look at where markets are trading ahead of the trading day later today. If we just take a look at U.S. equities to start trading a bit flat right now, but that is coming after we did see equities rebounding after we got that news about the potential or the pause on tariffs from the Trump administration. U.S. equities actually started the day on Wednesday with an early drop before closing higher. The S&P actually snapping a two-day losing streak. We mentioned the global bond rout. Uncertainty is part of the story. Also, it's the story about defense spending in Germany. We did see German bonds having their worst day since 1990, as we mentioned there, and the sell-off is continuing right now with German bond futures down right now just about 0.7%. But a lot of this uncertainty in the U.S. and Europe and potentially in the tariff trade wars, potentially a boon when it comes to emerging market assets. Right now, we're seeing the MSCI Emerging Market Index up more than 1%. Potentially, we're seeing capital flows from other markets pouring into some of these other markets. And we also did see EM currencies and bonds tracking higher. Finally, Brent crude on the board right now, up just over 0.5% there to trade at about $69.67 a barrel. Although we have seen quite a bit of downside when it comes to Brent crude. Morgan Stanley actually lowering their forecast for the rest of the year for Brent crude, citing tariffs as a major headwind. And I just want to bring you this terminal chart really quickly on foreign exchange and the euro. Our MLive team is saying that the euro's rally may have only just started if we do see more EU leaders following Germany's lead on spending. But this chart showing that we've seen the currency up over its 200-day moving average as compared to the U.S. dollar. And of course, we are waiting for that ECB meeting to come later today. Let's, though, now check in on how markets in Asia are faring. Avril Hong is standing by in our Singapore with a look at that. Avril, what are you watching?
We're focusing on Chinese assets. I mean, we have seen this week double the level of tariffs on China. No word yet on whether there's any way they could be rolled back, but that doesn't seem to matter for Chinese equities. And as our MLive colleague Mary Nicola put it, they're basking in the afterglow of the NPC, really liking those positive sound bites and the focus on tech and consumption. You look at the Hang Seng Tech, it's at the highest level since December 2021. Of course, it's fueled by the surge in Alibaba today. You talk about good timing, right? Because this also coincides with the Chinese tech giant taking the wraps off its AI model, which it says can rival DeepSeek's. And of course, this is a stock that has surged 70+% from its January lows. Now, aside from tech, property also doing well today. This is a gauge of property developers listed in Hong Kong, and they're climbing on reports from local media that there could be further property restrictions easing in major cities in China. On top of all that, we're also looking ahead to a big briefing later today, Jen.
Yeah, that's right. So Avril Hong in Singapore for us there. Avril, thanks so much. Let's just stick on what Avril left us off there with. China's finance and securities chiefs will hold a news conference in just a few hours. This after the nation set a GDP growth target and in the wake of U.S. tariffs. Asia government and economy correspondent Rebecca Chung-Wilkins is joining us now for more. So Rebecca, walk us through what the expectations are here from this briefing.
Yes, we will be joined by bigwigs really from all of China's key ministries and institutions. A couple of big ones to watch. The PBOC, for one, because of this potential plan to follow through on easing. Been very, very closely eyed. So far, the PBOC is very much focused on trying to stabilize the yuan. But there is also this growing pressure to move and to allow some kind of easing when it when it comes to taking a looser monetary policy stance. And then also we of course have the Ministry of Commerce. Now this is the ministry that really deals with all the riposte to tariffs that are coming, all the criticisms from the EU and from the US over, for example, rules around competition, subsidies and the like. So we will also be watching closely to see what their responses to this growing context and the growing challenge of being trapped in this trade war. Elsewhere also we'll be looking at the regulators to see any other moves to try and improve access to funding for small and medium enterprises. In all, it's really all about what the ministries and what these sort of top chiefs are going to be doing to try and implement Li Qiang's work report that was presented at the MPC. The number one focus there, just to remind everyone, is really on consumption. It was the top priority for 2025, and that comes all sort of down essentially to ways in which China can combat and offset the impact of those tariffs.
Rebecca, are we likely to hear officials then commenting on some of the challenges, to those growth goals?
Well, I think part of this will be what investors are really looking to see is whether or not we're seeing a more short-term shift to try and boost consumption or a long-term shift. And it's that long-term shift that is much more challenging because it really is to unleash sort of demand in the Chinese consumer. It all comes down to these much more long-term, expensive and costly moves. So, for example, increasing and improving the social welfare system. China actually, comparatively speaking, has a relatively threadbare social welfare system. It's also down to how tax reform and how provinces earn their revenue. So, for example, provinces at the moment really profit by producing. But if you want people to be consuming, you also need to be rewarding local governments who are encouraging spending rather than just producing to sell to other provinces. So these are sort of these long-term structural challenges that China faces when it comes to transform its economy to something that's more led by consumption, moving away from sort of supply-side model to a demand-side model. So I think there'll be this calibration. On the one hand, we're seeing these short-term policies that are going to boost consumption, things like the trade-in program that we already see, potentially expanding that to services and other areas, versus any potential moves for that suggest sort of more long-term planning.
Bloomberg's Asia government and economy correspondent Rebecca Chung-Wilkins. Fascinating reporting there. Thanks so much for joining us with the update there on the meeting and the briefing that we're expecting later today. Let's move to the Middle East, though. Bloomberg has learned that Saudi Aramco is considering a potential offer for lubricant assets being sold by BP. For more, let's bring in Bloomberg's Matthew Martin in Riyadh, who also did a report on this story for Bloomberg. Matthew, what does Aramco see in Castrol? Give us some insight into what you and the team dug into.
Yeah, good morning. Well, look, as we had reported earlier on, BP is doing a review, a strategic review, as it looks to find new ways of growth and, coping with this new energy environment that we're finding. And one of the things that is potentially going to come up is a sale of this Castrol lubricants unit. This is very well known, operates all over the world. It has this listed subsidiary in India as well. Overall, this could be worth around $10 billion. So this is going to be a huge asset if BP decides to pursue a sale of this. And what we've seen is, what we've reported is that Aramco is looking at this and is considering making an offer for it, either all of the business or perhaps looking at parts of it. One of the things we've seen is Aramco is particularly keen on getting into these areas of retail and moving from being this business which is just entirely about pumping oil and gas and then shipping it to someone else to refine and sell, and moving more into areas where it is actually touching consumers and it is actually selling products with an Aramco brand to consumers. And so getting into Castrol and then potentially merging it with the Valvoline business that it bought a couple of years ago would be another way for Aramco to get itself closer to consumers, get further down the value chain, and being able to extract more value out of the oil that it produces for itself, and losing less of that value further down the supply chain.
Yeah, focusing more on the downstream. Matthew, when it comes to Aramco's earnings that we got earlier in this week, we saw lower profits and dividends. How does that factor into this potential multi-billion-dollar deal?
Yeah, well, look, I mean, this is one of the interesting things about Aramco now is that, we've had lower oil prices for a while and quite low production volumes for Saudi Arabia. So that has all translated into lower profits for Saudi Aramco. That clearly is not deterring it from still wanting to pursue these big multi-billion-dollar acquisitions, because it wants to secure the sale of its crude, both in new markets and growing markets like India and Asia, but also because it wants to diversify out of just being an oil company and into being perhaps more of a broader energy company. It's spending billions of dollars as well, expanding in its gas production as well. So even in this environment where we're seeing Aramco's balance sheet becoming slightly more strained because of low oil prices, it's not deterring it from still being prepared to pour billions of dollars into investing in these areas where it sees growth for the future. And let's just remember that even with this period of lower oil prices and lower profits that we've had, I mean, the company is still has very, very low debt levels. It still throws off a huge amount of cash, so it still has a huge amount of capability to borrow and to go out and continue investing in the new areas where it wants to be more present in the future.
Great reporting there. Bloomberg's Matthew Martin, thanks so much. And you can read Matthew's story with the team out now. Now, let's pivot to the president of Emirates. He's told Bloomberg the airline industry is in uncharted territory after Donald Trump's tariff policies ignited a global trade war. Speaking with the opening trades Guy Johnson, Tim Clark said while its impact is uncertain, the carrier has navigated difficult circumstances before.
With the announcements of these tariff arrangements between Canada, Mexico, and possibly even Europe going forward, we're in uncharted territory, Guy. One can see inflationary pressures coming in as a result. We can see that affecting discretionary incomes with regard to how they impact demand for air travel. But I'm not saying that we've been here before, but this airline has been used to sort of global traumas of some status, if you like, over the last 15 or 20 years, more actually. So we'll have to navigate our way through it. The demand for our services in the next 6 months or a year are very strong, irrespective of this. But which way this goes, it's uncharted. So we'll just have to wait and see.
You've, in the past, proved to be very flexible and adapted the network very quickly to take advantage, you could argue, of some of the disruptions that we've seen. But President Trump last night warning of economic discomfort. You talk about the fact that demand is holding up at the moment. What does economic discomfort, do you think, mean?
Well, I think as far as the airline is concerned, it means that the decisions taken for travel may be compromised, reduced, the scale of which I'm not altogether sure at the moment. My own view is that this will resolve itself. There will be, over the next 6 months, a year, a reset. I think the level of tariff will possibly fall depending on which countries enter into some kind of transactional arrangement with the United States. I think this is just the beginning of a period of uncertainty. As the president says, economic discomfort. Will it last forever? No, I don't believe that for a moment. The global economy is in a little bit of a fragile state at the moment. But, you know, there are a lot of things going on which will survive this what could be a tariff war. And I remain optimistic that certainly we can work our way around all of these particular issues going forward.
Emirates President Tim Clark speaking to Guy Johnson about the impact of tariffs and geopolitics on the airline. Now, coming up, the ECB is widely expected to cut rates today, but internal divisions are complicating the path ahead. We're live in Frankfurt on Decision Day. That's next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. The European Central Bank is nearing the final leg of its interest rate cutting cycle, with internal divisions set to complicate decision making over the months ahead. Let's go straight to Lizzie Burden, who's standing outside in a quite cold Frankfurt for us. Lizzie, thanks so much for joining us. So a cut expected today, and then what happens?
Well, that's the question, Jen. Analysts are divided on what happens after April, and that's because the Governing Council is so divided on what happens after April, and that's because we are approaching the rate that many see as neutral. Now, you've got some analysts saying after today there'll be no more cuts. You've got some saying that they'll cut all the way to 1% by early 2026. On the Governing Council, you've got some who are still concerned about sticky services inflation and higher energy costs, others who are concerned about sluggish growth. But we did get some encouraging data this week on the inflation front. You've had services inflation falling below 3.9% for the first time since April 2024. Wage growth easing in the fourth quarter, both giving us signs that actually maybe they can get back to that 2% inflation target. So what I think will be really crucial for markets as a signal is whether they drop the language about policy being restrictive. If they do, many would interpret that as setting the stage for a pause or even an end to rate cuts. But if they don't, many would see that as a signal that you're going to get another cut at the April meeting.
Lizzie, does what we've seen from Germany and the financial boost that they are now unleashing change the calculus at all, or how does it affect it?
I mean, that meeting has got to be one of the most exciting in some time for that reason. It is a paradigm shift when it comes to this whatever it takes moment, which of course harks back to a former occupant of the ECB, Mario Draghi, the former president who uttered those words all those years ago. In terms of the market reaction, of course, that has been historic itself. You saw bonds with their worst day since the Berlin Wall's fall yesterday, and euro-dollar moving away from parity. Some saying you should be buying the euro at this point. But for our purposes, Jen, it's the impact on ECB bets that is the most important. So traders paring their bets to 67 basis points of cuts this year off the back of these policies, down from 90 basis points of cuts at the start of the week. And that's because it's seen as adding more to growth than it would to inflation. Goldman economists saying that you could see a boost to German GDP of as much as 2% next year. That's up from 0.8% previously. But of course, it completely depends on it being approved and being implemented quickly. And of course, we're going to await the news out of the European Council meeting that's happening in parallel in Brussels today. I am sure that President Christine Lagarde is going to be asked about all of this today, Jen, and I'm sure she'll be asked what is the ECB's role in supporting all of this policy.
Yeah, busy day over there. Bloomberg's Lizzie Burden in Frankfurt. Lizzie, thanks so much for joining us and for braving the cold for reporting there. Now, coming up, another central bank has a decision today. Turkish annual inflation has dipped to its lowest point in almost 2 years ahead of an expected rate cut later today. We'll get the latest next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Turkey's annual inflation rate dipped below 40% last month, the lowest print in almost 2 years, ahead of an anticipated interest rate cut later today. For more, let's go to Bloomberg's Turkey Deputy Bureau Chief, that's Beryl Akman in Istanbul. So, Beryl, what is the expectation for today? There's been a few divisions on what exactly we'll see.
Good morning, Jennifer. Today we're expecting the Turkish Central Bank to go ahead with a third straight rate cut. The median forecast in a Bloomberg survey is for the central bank to deliver a 250 basis point rate cut, which would bring the key rate to 42.5%. And if that happens, that would follow a pair of 250 basis point cuts in the last two meetings in December and January. Like you mentioned, we saw quite good inflation data for last month in this week, just showing that inflation in February dipped to 39% in annual terms, and that has strengthened the calls for another sizable cut today.
What does that mean, Beryl, in terms of forward guidance, especially when you factor in a lot of the influences that the central bank is having to piece together?
So far, the guidance from the central bank has been that it assesses decisions meeting by meeting. And in a meeting last month, central bank governor Fatih Karahan said that they're not on autopilot and they can pause or even reduce the size of rate cuts should the inflation outlook worsen. Now, inflation data from last month show that the central bank likely won't opt for that decision today. But like you said, future guidance is crucial, and that's what investors are looking for, whether the central bank can give any signs of slowing its cuts or pausing in future meetings. We'll be on the lookout for any guidance on that in today's Monetary Policy Committee statement.
Yeah, we'll wait for that. Turkey Deputy Bureau Chief Beryl Akman joining us there. Thanks so much, Beryl. Great to get you on. Now, let's take a look at some of the other stories we're following today. Bloomberg has learned that the Commerce Department is tapping former Morgan Stanley banker Michael Grimes to lead a planned U.S. sovereign wealth fund. Sources say Grimes is leaving the bank after 30 years to head up the new wealth fund, part of President Trump's effort to give the U.S. a stake in projects he considers critical to national security. Bloomberg understands that Goldman Sachs and JP Morgan are among the banks acting as brokers to facilitate growing investor demand for ways to trade Russian-related assets. Banks have reached out to investors in recent weeks, offering ruble-linked derivative contracts, a trade that is allowed under Western sanctions. The ruble has jumped some 20% this year, the biggest increase in the world. French President Emmanuel Macron says he will open talks on using his country's nuclear capabilities to defend European allies. The remarks come ahead of an emergency meeting of EU leaders in Brussels for talks on Ukraine and the continent's wider strategy. Macron says his decision also follows a request from German Chancellor-elect Friedrich Merz. And let's just take a quick check at your markets before the trading day gets going, at least in the U.S. and in Europe. Right now, we're seeing U.S. equities trading down ever so slightly, but we did see a bit of a reversal, seeing major U.S. indices closing higher after we did see that tariff announcement get put on pause, at least for the time being. Euro Stock 50 futures up just about 0.7% there. Again, a busy day in Europe with the ECB meeting coming later today. But that is it for Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Stick with us for Daybreak Europe. This is Bloomberg.